Did you know there are 6 false beliefs that might be holding you back from financial freedom? Hi, I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In this episode of our podcast, I sit down with Doug Kinsey, Chief Investment Officer at the Artifex Financial Group. With over 25 years of experience in financial services, Doug brings a wealth of knowledge and a fresh perspective on how to grow and protect your wealth. Doug's passion for investing started early, reading books on finance as a child and developing a lifelong curiosity about businesses, new ideas, and hidden value. Today, he challenges conventional thinking by questioning the limits of modern portfolio theory, the dangers of over-relying on statistics, and the blind faith in indexing. Instead, Doug makes the case for a smarter, more common sense approach to active management, one that puts careful research, patience, and sound judgment back at the center of investing success. If you're ready to uncover the false beliefs that may be sabotaging your portfolio and learn how to invest with confidence, this episode is for you. Let's get started with the interview. Doug, welcome to the Simply Investing Dividend Podcast.
Glad to be here. Thanks for having me, Kanwal.
We're so happy to have you here on the podcast today. I think our audience is going to learn a lot. You've got a lot of experience, more than 25 years in the industry. So let's get started from the beginning. I was looking at your bio here, and you started the Artifex Financial Group in 2007. And that was right before the 2008-2009 financial crisis. So why did you start this group, and how did things go in the next 2 years?
That's a great question. Why did I start the group is pretty simple, but it kind of evolved in a complex way. I had worked for other firms previous to this. I started my financial investment career with Morgan Stanley. I was then hired to start a wealth management group at a regional bank, pretty well known one in the United States, for a division of the bank in Ohio. And through my career, I've really always wanted to give the best advice I could to people without conflicts. And it just became very apparent working for these larger institutions that I couldn't avoid conflicts affecting the advice I gave to clients. So one of the people that worked with me at the bank became my founding business partner. And he still is my primary business partner. And so we decided, you know what, timing's pretty good. The technology's there. We can affiliate ourselves. We started out with TD Ameritrade Institutional. We can affiliate ourselves with a stable, recognizable custodian that will help us get started. And so we did. And we started a fee-only wealth management firm, fiduciary focused, with no conflicts from the standpoint of commissions or incentives to do anything else for the client. And it's been a very liberating, enjoyable experience. I mean, I've been at it, as you said, for quite a while, and I still get up every day and enjoy it. I love investing. I'm as I said, Chief Investment Officer for the firm. I'm also CFP and Certified Investment Management Analyst. So I love researching companies. I love finding good ideas. I love to see them work. And the way we're established is the better our clients do, the better we do. I mean, it's a very symbiotic relationship. Doesn't mean I'm always right. Nobody's always right in the world of investing, since we can't control the outcomes. But, you've got a lot of historical information available to you, and today more than ever, all kinds of immediate information to help you make decisions. So if you just have a good philosophy and stick with it, you're going to be fine. So yeah, I
So
mean,
then,
that's why we started, and that's where we are today.
yeah, no, that's a good recap there. But then, so immediately afterwards, in 2008, 2009, we hit the financial crisis.
hmm
How did that impact, or was there any impact to your firm?
Well, not for our existing clients because we work with a lot of pre-retirees, so we were always pretty careful and conservative for those clients. We had a fair amount of overall assets in United States Treasury bonds, so that helped. In addition to our stock models that we utilize, it actually ended up being good for the firm because we were able to, at a certain point during the crisis, realize that a lot of these companies, if you've ever studied Benjamin Graham, which is Warren Buffett's hero basically, and the value investing philosophy, it was really hard to find stocks adhering to that philosophy prior to that crisis. I mean, the PE ratios are through the roof, and you just all of a sudden we're faced with well-known companies that we loved with single-digit price earnings ratios. So we thought, hey, let's start to put money in the stock market and develop these modeled portfolios. And it was a good time to do that. And we've never looked back. And also with financial advisory firms, a lot of times people become complacent and they don't really look for financial advisors when times are good. So when times become challenging and they become confused and maybe worried, that's when they seek the services of a professional. So it actually was a beautiful time to start the business, as challenging and fearful as it was.
Yeah, no, that's good to know. And you did touch on some of your models, and we talked about it before we hit record, which was the one of the dividend models. So I do want to get to that, but not just yet.
Okay, that's
What
fine.
I really enjoyed reading this morning was one of the publications. You had written this a while back, right? And it was called The Six Failed Beliefs That Could Be Damaging Your Financial Well-Being and What to Do About It. So what I'd like to do is let's go through the six beliefs, and then we'll go back to what the dividend model is and what that looks like.
Okay.
So let's start with belief number one, where you said mutual funds are investing. So what did you mean by that?
Well, I think, what I was trying to get at is they are obviously investing, but they're not. I think we've gotten away from paying attention to exactly what it is we're trying to accomplish. People I think most people become acquainted with mutual funds through their retirement accounts normally, whether it's 401k or IRA or whatever it is. And they tend to look at just the performance numbers, and they tend to look at the mutual fund itself almost like you'd look at a stock. And it's not. It's a pool of investments. It's a managed fund. And you have a percentage of that fund. So you're really hiring an investment manager when you invest in a mutual fund. Yes, you end up with a pretty insignificant piece of a lot of different investments. But you're dependent completely on how well that manager does, which can, if you're not careful, it can introduce a degree of risk that you didn't count on. Does that make sense?
Yeah, it does. And I think what if the fund manager changes and they swap them out with someone else, right?
Exactly.
Yeah.
And most people don't look at all that, and really professionals do. I mean, when we look at mutual funds, we look at the tenure, how long the management team's been in place. Does this look like it's repeatable performance? Because as you may know, 80% of the mutual funds in the universe don't exceed their benchmark typically. So you end up paying for something that doesn't really deliver value. So you have to be extremely careful with the managers you hire. And take not only a look at their performance, but how often they turn the portfolio over, because that indicates a lot of decisions potentially being made, and you're not going to make a good decision every time. The tax ramifications of their strategy, etc. So there's a lot more to it, as opposed to just going out and saying, okay, I like Procter and Gamble as a company. Now I can evaluate Procter and Gamble as a company. I can evaluate their management. I can look at what their products are. I can look at their financials. And so I myself can take a look at that and say, I like that company. I'm going to keep it for a while. Right? There's nobody else in that transaction but me and the company I'm buying. So that was my idea.
Yeah, no, that's a good way to put it. Let's move on to belief number 2. Stocks are risky.
Yeah. Well, it's less so today, but let's say back in the 90s when I really got started in the investment side of the business, there were a lot of people who either survived the Depression or were children of Depression survivors. And those people, I would have people tell me, I don't want anything to do with stocks because they were so concerned about that. But stocks are not inherently risky. I mean, they are volatile because they're traded every split second of the day. And you can't pay attention to that. So I don't think the vehicles themselves are inherently risky. Yes, some companies, don't forget you're buying a share of a company. Some companies are riskier than others. And at certain moments in their life cycle, they're going to appear, or they actually may be, too pricey to buy. And that's when you get back to the Benjamin Graham style of investing, which is buy everything at a discount. Really hard to do that today, but you can buy at a reasonable price, maybe, So buying companies themselves is not risky. It's just, what are you buying? I mean, that's what you have to be careful about. So the idea that stocks are risky is, I think, a misnomer.
Yeah, I agree. I've been doing this for over 25 years as a dividend investor, invested in individual dividend stocks.
Mm-hmm.
So I'm going to reiterate what you're saying. It's the biggest thing is, what are you buying, right? So we can't just make a blanket statement and say, yeah, stocks are risky, I'm not going to get involved. It really depends on what you're buying. Let's move on to belief number 3. Bonds are safe.
Well, we've most recently seen that they're not. Yeah, bonds that's an asset class to me that you love and hate at the same time. I mean, the only reason anybody puts bonds in a portfolio is for diversification and to try to limit volatility. I mean, yes, there are income investors who may look at bonds as a source of income. But to me, it's like any other asset class. It's got to add value to what you're doing. And okay, so we just went through a period of time, pretty much since the beginning of my career up through a couple of years ago, where interest rates just were coming down. And really, before the pandemic and ensuing pockets of inflation, we had interest rates that were threatening to go negative. And I would hear investment professionals from the big firms say, oh, there still may be a reason to buy those. And I think to myself, what? What reason would I have to buy an asset that's going to deliver me a negative return? So anyway, you've got a situation there where at that point in the cycle, when interest rates couldn't get any lower, I mean, you really very little incentive to even have bonds. And now, of course, bond interest rates are going up a little bit. They've come down recently as of yesterday, but I don't think it's like anything else. There are cycles in the bond market too. And I think, like you just said, with stocks, what are you buying? I mean, it could be great. It could be a good company. It could be a reasonably priced bond. Fine. If it gives you a return and a cash flow that you're looking for, great. Put it in your portfolio. We've actually been using money market funds in lieu of bonds for the last couple of years because we were able to get 4 or 5% money market with very little risk. and it's a diversifier. Not real exciting, but very liquid. And yeah, it diversifies a little volatility away from stocks. So I just, yeah, I think people today are a little bit less in love with bonds than they used to be. But the idea that they're riskless is not true.
Yep. I think it comes back down to what we said before is what are you buying? What type of bonds are you getting? And
Mm-hmm.
you're right. We had a long period, I think, before COVID. I'm going to say around 10 years where interest rates were very low,
Mm-hmm.
borderline 0%, right? And probably didn't make a lot of sense to put money in bonds at that time. Um, okay, let's move on to belief number 4. Homes are a good investment.
Yeah, and I'm sure you can debate this one every which way, but people have this idea that their home is a good store of value, when in fact it really isn't, because in reality, homes don't appreciate much more than 4% maybe on average, at least in the United States. And I think that's probably true throughout most of the developed world. But when you take into account not only that lower rate of appreciation, but what you put into that property as a homeowner, a lot of people forget about the expenses and the upgrades and the maintenance and the costs of owning that property. When you factor in all of your costs, most people aren't doing as well with their home as they think. Now, it is a somewhat decent investment when you consider you do leverage the heck out of that asset. I mean, it's the one thing you can buy for 20% down or less. When you factor in that piece, yes, your rate of return may look better, but when you get to the point where your home is paid off, now you've got an asset that's growing maybe 3, maybe 4% a year. That's not a great return, right? I mean, it's okay to have, it's a diversifier, but let's not get too excited about non-income producing real estate.
Yeah, I think for most people, it's going to be more of it's an emotional decision, right?
Right,
If you don't want neighbors living below you or above you on the side,
right.
then a home's going to give you that. But you're right about the investment piece. I was just looking at a report out yesterday. Even here in Canada, in Vancouver, Toronto, condo prices are down. They're down 15% or more.
Hmm.
So if anybody was buying those thinking that it's going to be an investment, um, I'm not sure, right? Now I don't know where the prices are going to go, but this is as of yesterday. There were showing that prices are down year over year. Um,
I do like investment real estate, real estate that produces cash flows for investors. But again, it's everything has a value that's appropriate or not appropriate at any given time. And real estate is no different. There is some non-correlation with equities, but real estate is a lot more correlated to the economy than you think. So, got to be a little careful there.
yeah, absolutely. Let's move on to belief number 5. Modern portfolio theory is my salvation. Now, Doug, can you explain to the audience briefly what is modern portfolio theory?
I don't know if I can do it briefly, but in a nutshell, it's all the finance theories that lead us to the development of the risk return trade offs in portfolios, and the fact that you can build an efficient frontier based on the expected return versus the risk, and how combining these different types of assets can produce an overall rate of return, overall risk and risk profile for a portfolio. It involves capital asset pricing model, which really is too complicated to discuss here. And it's really what the financial planning and investment industry has really probably pinned themselves to for the last 20, 25 years. I mean, and I think blindly so, because again, you've got changes in the economy, you've got things you got to look at. when it comes to those models. And if you go too far overboard, you're going to have assets in there that maybe look good in theory, but don't do much for the portfolio and may even detract from performance. You see it in a lot of financial planning tools when you see a recommended portfolio and you got a pie chart with like 10 or 12 different asset classes on it, right? And so it's a beautiful pie chart. It makes it look like, somebody's put a whole lot of effort into this, and it's a matter of, well, let's just implement it, And I come from my personal perspective is yes to a point. Everything to a point, right? I mean, as an investor, you have to be balanced in your thinking, and not just grab hold of every shiny object. And to me, modern portfolio theory has kind of run its course.
Now, is efficient market theory a part of that? Like, is that the one where people believe that stock prices are what they are today because everything's already been factored in? All of the risk, all of the growth has already been factored in the stock price today. Is that part of modern portfolio theory?
I mean, it could be. I mean, some of the guys that created modern portfolio theory were also involved in the efficient market hypothesis. And, they're very smart people. I've met some of them. I can see where they came from, particularly back in the day when it was developed. And yes, it's true that market prices do reflect the thoughts of all the investors in the market. But if you believe that completely, you would say there's no reason to worry about evaluating individual stocks from a fundamental perspective. There's no advantage to be gained. And I don't believe that. I also don't believe that all of us are smarter than a few of us or one of us. I think when you get to the investment markets and everybody who's invested and the volatility that shows through with like index funds on a daily basis, that doesn't to me indicate that all of us are smarter than a few of us. I just don't buy it.
Yeah, I still think that there's, I consider myself a dividend value investor. So I've followed Ben Graham's approach as well. And there are at times very good high quality stocks where the fundamentals are great, but the stock price is really low.
Right.
For some reason or another. Right.
It could be
that kind of goes against the efficient market theory, right?
Yeah, and it could be as simple as market sentiment. Like, right now, I mean, I'd say most of this year, the market has done pretty well, but not because of anything that's happening from a political or economic standpoint. I mean, the politics here in the United States have created a lot of uncertainty in world markets, including our own. It's largely been due to the developments in technology I'm so focused on alternative investments, AI. I mean, it's if it hasn't been for AI, the market wouldn't be where it is. And then so now you've got other companies, maybe like the Procter & Gamble's of the world or the General Electrics, who maybe aren't as sexy, that may present relative value to you.
Yep, absolutely. So that was belief number 5. Modern portfolio theory is my salvation. I don't think it is, right? That's one of the failed beliefs. Let's go on to the last one. So the last failed belief number 6. My broker, insurance agent, banker is a financial planner.
Yeah, well, anybody can call themselves a financial planner. I mean, anybody can call themselves a financial advisor. So you kind of have to dig deeper. It's a very friendly term that people throw around to make people think maybe they've got more knowledge and experience than they do. When in reality, a lot of people who call themselves those things are really just trying to either invest someone's assets into a preferred fund or insurance product or something of that nature, where they can earn additional compensation. I really think you've got to look closer at someone's experience, their training, their credentials, and really their philosophy. And first and foremost, are they obligated to hold my interest first and foremost, not secondly or thirdly, but firstly.
Hmm. Yeah, no, that's really good to know. And on our podcast, we're laser focused just on investing, dividend
Mm-hmm.
investing.
Mm-hmm.
But there is a lot more to that, and you're involved in sort of because you handle other people's money. There are other things to consider than just the investing piece, right?
Mm-hmm.
Uh, do you get into with your clients for example, like estate planning, tax planning? Do you do any of that with your clients at all?
We do. Most of our clients, we're kind of unique, sign up with us as a flat retainer. So we don't charge them based on assets under management. Um, we charge them a flat fee that includes investment management, tax prep, tax planning, estate planning in some cases, if not all cases. So we're not always the in-house experts. We may bring people in from outside to help. We'll evaluate someone's risk management needs and help them make the right decisions with insurance, although we don't sell it. We're not going to provide it, but we'll help people decide on it. So we're designed to be true financial advisors. When somebody hires us, we're like an extension of their family, and they have a question they want to run by us on any financial topic, we'll try to find an answer. I mean, I've recently have advised a client on the sale of a property or a piece of real estate and helped him determine what the value of that property is really worth. And in this particular case, I think my advice helped him increase the value by at least 100% over what he had initially been shown.
That's incredible.
I mean, it's just stuff like that. I mean, if we have the expertise, we're going to try to help. Does that answer your question?
Thank you for that.
Yeah,
it did. Absolutely. So that's great. We covered the six veiled beliefs. Let's go back to what I was saying at the beginning about, you had mentioned about a dividend model.
Mm-hmm.
Could you explain to the audience what that is? What is your approach around that? How did you develop it?
Good question. I should preface that by saying I don't have a preference as a firm investment manager, but there is a place for a dividend income producing portfolio for certain clients in certain situations. I also think there's a place for it, and this may be for a lot of your listeners, people getting started investing, want to do it on their own. I think it's a great place to start. The interesting thing about dividends is, there are many interesting things about them, but dividend companies, but they typically tend to be more mature companies who maybe aren't doing a lot of innovation, but they're more stable. They're earning good profits, and they're returning those profits to shareholders. And that's attractive to some clients. It can also smooth the ride from a volatility perspective because the interim cash flows tend to moderate that. And you've got companies that typically are not too as volatile, maybe. We have, any number of retired clients who don't want the volatility, but they want to know they're getting some income no matter what that stock does, no matter what that company does. So that's what I look for. It's really hard to get decent rates of return when you're buying like a dividend index fund or a large dividend mutual fund. So you should probably maybe, be a little more focused with your holdings. So in our model, we've got, some are usually around 25, maybe 30 names in there. And I will say, I've got to pull up my portfolio here just so I can refer to it. we've got a variety. I try to be diverse in terms of the holdings, industry-wise, sector-wise. Companies like Prudential Financial, the insurance company, um, Pfizer, Dorchester Minerals, which has always been a very high dividend payer, Sun Life, Chevron, Pepsi, Merck, Huntington Bank, Exxon, American Electric Power, Coca-Cola. Overall, we've been able to achieve close to about a 4% yield on this right now. So that's pretty good. And if you're a more conservative investor, maybe all you want out of your portfolio is maybe 6% a year, 6 to 7% a year, and you can accomplish that with a dividend model without a whole lot of risk. So I think that's where that's how I go about it. I look at the fund. You're very much a fundamental investor when you're looking at dividends. You're looking at the cash flows of the companies and how sustainable they are. Are they reaching to deliver dividends? You've got to be a little careful there. So, I mean, we've got a few things in there that are exchange traded funds or mutual funds even, but most of it is individual securities. And, over 17-year period or so, I mean, it's returned 12% a year. Now, some of it has come recently, in the last couple of years, and I think due to all the fluctuations in our economy and some of the things taking place in the United States, there's been a little bit of a flight to safety, and also with the emphasis on reshoring. So dividend stocks can be in and out of favor, at any given time. But I think if you're a long-term investor and you want to keep things simple, I'm sure you feel the same way. It's a great way to invest.
Mm-hmm. Yeah. So Doug, as I mentioned before, like our audience is DIY investors. They're looking at individual stocks. Mm-hmm. What are some of the things that they should watch out for, right? Because these are, like the average investor, we don't have access to a Bloomberg terminal. We don't, we're just looking at Yahoo Finance or looking at a company's financial statements. And, we're looking at 5, 6, 7 dividend stocks. What are some red flags, things that, we should stay away from if we see that?
Well, I think you have to have some feel for cash flow analysis and be careful that, make sure that you're not seeing a situation where the dividend's at risk, maybe because they're paying too much. They may be paying too much to attract investors. Sometimes you see that from real estate investment trusts. Well, real estate investment trusts, by their very nature, have to pay out, a high percentage of their income to investors. But business development companies, sometimes you see it with commodity companies, where you see a really high teaser dividend. So I think you have to understand what would be a kind of a expected dividend for that industry. And that doesn't mean you shouldn't go for something that's maybe better than the industry, but just make sure you feel comfortable with that company being able to continue that payment. I think that's probably first and foremost.
Is that looking at the payout ratio, sort of comparing the earnings per share to the dividend to see how much are they paying out? Okay.
Yeah.
Yep. What about, I've seen stocks out there that are today paying a yield of like 18%, 20%, right? We call those dividend traps. Mm-hmm. What do you think about those?
They've always scared me. To me, if you buy one of those, you're going to have to potentially become a trader. That seems like an exorbitant dividend. Who are the companies paying those? Do you recall?
No, it was a couple of months ago. I was looking at it. Yeah, I don't want to.
Well, they're always out there, right? They're
always out there. Yeah.
And so I think, I don't know. To me, that would be frightening. The highest dividend payer in our model right now is paying maybe 10%, and that's Dorchester Minerals.
Mm-hmm.
But that's a mineral rights company, so really you don't have a lot of operational things happening.
Mm-hmm.
So you would expect that with that type of company. But I think much more than that, you got to really start asking a lot of questions.
Yeah.
It is interesting. I think a lot of these companies, because of artificial intelligence being sort of the sector that's really favored right now, I think there's been some shift of money away from maybe some of these more stable companies, and that's going to affect the dividend if the price of the company comes down, the dividend rate, the percentage payout anyway.
Yeah, the yield's going to go up.
Yeah. So this may be a great time to be looking at this stuff. I mean, I know Pfizer has gotten beat up, and Pfizer is overall a good company. Maybe the near term is challenging for them. But I mean, this may not be. Looks like the yield is almost 5% on that company right now. I mean, I'd have to look, but that's pretty high for that particular that particular stock.
So, Doug, do you look at a company's, again, let's say we're looking at a dividend company, would you go back and look at their historical, earnings per share? What does the last 5 years or 10 years look like? Have they been profitable, or have the earnings been completely random? Do you look at those kind of things?
Yes, definitely.
Okay.
And I
How
think,
far back would you go?
well, I will start out going back as far as I can, But really, you're only looking at, I think, 10 years of data is probably the limit that you're going to get anything somewhat reliable. And then I'm gonna look at 5 years and kind of shorten it forward, to see how things are transpiring. But yeah, you want to look for, and you also want to take into consideration how stable the company is, and do they still have a good business? It may not be an exciting business, but is it a good business, right? Is it one that's sustainable over time?
Okay. So, Doug, the other thing that I get a lot of nowadays, comments, email, people messaging me, is that there is a lot of people are fearful at this point because of the tariffs, the trade war going on. Now, I know as of this recording, yesterday there was a cut in the interest rates in the U.S. and in Canada. They both did the same thing yesterday. I think the cut was identical. I think it was 25 basis points, if I'm not mistaken. So what would you say to people that are fearful? Maybe they're just thinking about getting started investing. Should they wait on the sidelines, or should they get started today? What do you suggest?
A good question. If you had asked me this back in January, I would have said wait on the sidelines, because economic theory tells you that, and I still can't dispute this, that tariffs are a bad way to manage economies. They restrict trade, they increase costs, they impact domestic producers negatively. Everything about tariffs that you learn in school is basically bad. It does appear that this administration, maybe other administrations throughout the world, are just basically using tariffs as negotiating tactics, which makes me feel a little bit better maybe about what's happening as an investor. My big fear is that all this stuff will impact individual companies in the economy or in the consumer negatively. So I'd like to see every nation avoid that. And here we are in September, and I don't know. I mean, the domestic economy in the United States has been pretty resilient. Companies have been pretty resilient. So, we've. I hate to be too long-winded here, but in the recent years, we've seen a number of things that I never thought I'd see in my career. I mean, who thought we'd see a global pandemic, almost on the scale of the flu epidemic, in the 20s that killed so many people. I mean, maybe bigger than that scale, where we basically had economic lockdowns. We had people dying, I mean, in big numbers. Who would have ever thought we'd deal with that? And as an investment person, that was an interesting period. I certainly didn't expect the markets to recover as quickly as they did. So part of me says, don't be afraid. I mean, if you have conviction, and really look at your personal situation and what you're trying to accomplish. I mean, you shouldn't look at investing as a casino. It's not a casino. It's meant to accomplish something. It's meant to preserve purchasing power for you. It's meant to perhaps help you accomplish specific goals that you have. So make sure you're clear about that, and then back into that with your investment strategy. And if it includes a portfolio of dividend securities, get to it, put it together, and start making some investments. If you can, dollar cost average in over time with dividends, reinvest your dividends. And, 5-10 years down the road, particularly with dividend investing, you'll be surprised at what you've accomplished.
Yeah, absolutely. I think it helps to have a long-term perspective, right? If we're going to think about we're investing for the next 10, 20, 30 years, then, whatever's happening today might not be so bad in the long term in the markets, right? I always tell people if you're going to wait on the sidelines, you might end up waiting for the next 5 years, and then you've missed out on that growth over time, right?
Exactly. And I think, as an investor, particularly a longer term investor, probably the main thing you just need to be aware of is there anything happening in the economic markets where I'm invested, whether it's Canada, United States, Europe, wherever, is there anything happening that could impair capitalism in that country in the long run? And if there is, maybe rethink your philosophy. But God willing, that's not going to happen. I think there's too many people with vested self-interests, including President Trump, including our administration, Canadian, whoever. It's not in their best interest to hurt the economy. So we've got, think about that. But if it looks like things have gotten too wacky, and then you might say, well, maybe it's time to take a second look at this.
Yeah, I think that's a good way to look at it. And at the end of the day, I've been doing this for over 25 years as a dividend investor. I have to be optimistic about where the world is headed and where the economy is headed. Otherwise, we wouldn't be investing at all. So yeah, we want to take advantage of that. And there could be some opportunities in the future, like in hindsight. And I don't want to. COVID was terrible. A lot of people died. It was really bad. But if you look at March of 2020, a lot of the companies like Boeing, General Motors, Disney cut their dividend to zero completely. But in hindsight, there were opportunities if you were a value investor looking at some of the stocks there, right? So I guess you got to balance it out. Optimism and fear. It's sort of
right.
Balance it all out. Yeah.
Yeah, and to your point, I think if I'm a dividend investor solely, and a company cuts its dividend to zero, then, as a professional portfolio manager, I would have to say we need to find another company to replace that temporarily, because it's not doing what we asked it to do originally. And when it becomes a better value again, when it looks like the income stream's there to pay dividends, then we'll get involved again. Right.
Yeah, that's a good way to look at it. Absolutely. Well, Doug, I've enjoyed our conversation. This has been a tremendous help. Our audience is going to learn a lot from this and from your experience. Where can people get in touch with you? And I can put that in the description below.
Sure. Well, I can always be reached by email at doug.kinsey, that's doug.kinsey, at artifexfinancial.com, ARTIFEX financial.com. You can look me up on our website, artifexfinancial.com. And you can find my book on investing at Amazon. It's called Weathering the Storm. So you can reach out to me and maybe I'll get you a free copy. But I'm not really here to promote the book. Phil, I'm happy to be a part of this. I've enjoyed our conversation. I think we think a lot alike. And I'm an optimist like you are, or else I wouldn't be doing this.
All right. Thank you so much, Doug. We really appreciate having you on today. Thank you for coming on.
Thank you. It's been a pleasure.